This video comes directly from a question I was asked, and it's a good one. The question is this: instead of taking a $927 pension reduction to cover a surviving spouse, what do you think about the pension establishing a term life insurance, what I should say is the pensioner, establishing a term life insurance policy on themselves prior to retirement? The cost of a 20-year term policy is likely much cheaper than the $927 per month. And if the claim did need to get paid, it would be tax-free for the survivor. On the surface, that sounds smart. But when you reduce a pension survivor benefit using life insurance, you need to understand one thing. The decision has no undo button. Once you elect a pension option, it's locked in for life. No do-overs, no changing your mind later. And yet, people make this decision based on a quick premium quote or a spreadsheet assumption without fully understanding the risks they're taking on. So today, instead of options or blanket advice, we're going to walk through an example using real numbers and analyze whether using life insurance instead of a survivor pension option makes sense. So why does this question come up? This question usually sounds, again, something like this. Why would I permanently reduce my pension to protect my spouse when I could buy a term life insurance policy that's cheaper and pays out tax-free? But retirement decisions aren't just about math. They're about risk, longevity, and what happens if things don't go according to plan. So instead of assuming anything, let's analyze this question. So this scenario, this real life scenario, here are some of the facts that we see. The pensioner is 63, they're going to retire next year at 64, spouse is 62, does not work, both are in good health, pension is guaranteed, but there's no cost of living adjustment. Now let's look at what the options are. There's a single life pension option that will pay $7,541 per month and pays as long as the pensioner is alive. The survivor would get nothing after death. The second option is a 50% survivor option, which would actually pay $7,391 per month or $3,695 per month to the surviving spouse. The third option on this pension is a 75% survivor option, which would pay $6,614 per month while alive, and then it would pay $4,961 per month to their surviving spouse. Once one of these is chosen, it's permanent. So if we go back to the question that I was asked, the life insurance alternative, let's look at that and see, does it make sense? So instead of reducing the pension, the idea is to take the full $7,541 per month, buy a 20-year term life insurance policy with a death benefit of $2,262,000. When I looked up a premium quote on that, that was $20,192 per year or $1,682 per month. And I quoted this as a standard plus non-tobacco. So not the lowest rating, but not the highest rating, just given their age at 62, 63, not knowing what is going to happen with their life or if they have any kind of medical diagnosis, sleep apnea, things like that can impact these premiums. So I don't want to overstate their health. So, and then a guaranteed level premium. So that annual premium of $20,192 is level. It does not change. So how did we come up with the $2,262,000 that we were solving for? It was not random. The way we figured that out was what lump sum would we need to reasonably replace this income? And it was calculated by taking the monthly pension amount and multiplying that by 12 months, which gave us $90,492. And then we take that $90,492 and multiply it by 25. That gives us $2,262,000. The other way to look at this is if you use the 4% rule, you would need $2,262,000 to generate the same $7,541 a month the pension paid monthly. On paper, this looks very logical, so now let's put it to the test. This is where people are surprised. A 50% survivor pension monthly reduction compared to the full payout option was your monthly payout was reduced by only $151. So in exchange for that $151 less a month you would be receiving, your spouse would receive $3,695 per month. That would be guaranteed, no expiration date, no market risk, and no management required. Just mailbox money coming in. The other option, the 75% survivor option, reduces your monthly pension amount by $928 per month, or roughly $11,000 a year, and the survivor would receive $4,961 per month. So you give up a little bit on the front end while you're both alive, but the surviving spouse receives, in this scenario, about $5,000 per month. Slightly more expensive in what it reduced your monthly income by, but still guaranteed, still permanent, and still protecting both you and your spouse. So the life insurance strategy, how do we continue to look and see, does this make sense? So this life insurance, the annual premium would be $20,192 or $1,682 a month. If you paid this premium, this policy I got a quote for was 20 years. So your total premiums paid, if fully paid for over that 20-year time period, would be about $400,000. And that coverage, if you got a 20-year term policy, would expire at age 84. So at that point, the protection is gone and there is nothing left on to pass to your spouse. Where this might make sense. So there are potentially, to be fair, some scenarios where the strategy does work. If the pensioner passes away in their late 60s or early 70s, while the policy is still in force, their surviving spouse would receive a large tax-free lump sum. That provides flexibility, income replacement, investment opportunities, legacy planning for beneficiaries. And in that scenario, the insurance may certainly outperform the ongoing pension payment options. Here's where that strategy can actually break down. It takes $1,682 of the cash flow just to pay the monthly insurance premium. So if you started out at $7,541 and it took $1,682 of that cash flow just to make the insurance premium in this case, you would be left with $5,859. That's a big bite of the apple for a what-if scenario, and less money than taking the joint and 75% option, which would pay you $6,614 a month. Furthermore, if the pensioner lives beyond the 20-year term, the 84 years old, then the term policy expires and the spouse still depends on this pension income. There's no death benefit, no survivor pension, and there's no second chance to fix this. At that point, the spouse must rely entirely on remaining assets and market performance. Meanwhile, both the survivor pension options would still be paying had they chosen one of those. So the real decision in this scenario is not a rate of return decision. It's not a risk transfer decision. You're choosing who bears the longevity risk. Survivor pension, the pension plan. The term insurance would be the surviving spouse. And then the single life only would be the surviving spouse. Those risks are what you're trying to determine who bears that risk. And the risk doesn't show up on a spreadsheet. It shows up years later when the flexibility is gone. So What is my final thought on this scenario? The right answer depends on how much guaranteed income your spouse truly needs. How comfortable are they managing that lump sum if it would have gotten paid out? And how much uncertainty, this is the big one, how much uncertainty are you and your spouse willing to accept? If this were an episode of Mythbusters, I think we would have to bust this myth. I think in this case, it would not make sense to take out a life insurance policy of 20 years. At 60 years old, it's going to cost too much money in premium, and it reduces your living expenses, your cash flow from your pension too much that it doesn't make it worth it. So these are the things to consider. This was a fantastic question and a great thing for me to bring together and analyze so that you could make a clear decision on how do you choose which options to take. If this was helpful to you, hit subscribe. Make sure you hit like. We'll see you on the next video. Be confident in your retirement. Have a wonderful day.